Nikki, high-frequency traders are often blamed for a whole host of things, in particular, I guess, the flash crash, but many other things besides. I guess our viewers would be very interested to know, A, what's happening down the regulatory side of things, and B, after some news today, what various exchanges are doing on their own account in this area. Let's start with regulation. Where are we up to around the world now?
Well, I think in principle, most regulators are inclined to do something to check high-frequency trading or very fast trading, but most of them are still thinking about how to do it, and it's difficult. I mean, it's difficult in terms of the sort of lobbying campaigns that are being fought at the moment, and quite difficult to turn into sort of precise measures. Different exchanges work in different ways, quite how prescriptive you are. So that process, I mean, really is a sort of, you know, people are thinking about it. That's certainly the case in Europe. There should be legislation fairly imminently, but it's not hard and fast by any means yet.
And the main thing driving this regulation, let's just remember, is it the fact that some of these high-frequency traders are getting ahead of or benefiting at the expense of retail investors, or is it things like volatility and that sort of thing that they've got a problem with?
Well, as you rightly say, there are the two issues. There's the volatility, the flash crash is obviously the prime example, but I mean, only last week there was some tweet about a completely false tweet about White House explosions that caused the S&P to drop very sharply over a very short period. And although, I mean, it's always, I think, fairly widely accepted that high-frequency traders didn't cause the flash crash, obviously their presence doesn't help the market. If liquidity is being pulled, it can be pulled out very quickly and tends to be. That doesn't help market stability. I mean, the HFT lobby would say, well, actually that liquidity doesn't come out. But that's a debate. So there's that one issue. The other one is really the equality of treatment of market participants, and whether speed alone can make you money, and if so, is that right? And the high-frequency traders will say, well, we've invested quite a lot of time and money in coming up with programs, etc., and also that our presence brings down trading costs, narrows spreads, so we ought to be allowed in for that basis. Other people will say, well, no, it's a false, unproductive, unhelpful contribution to markets that is potentially dangerous. So that's where the debate is. I mean, what is really interesting is that some exchanges and EBS, the currency market, are in fact taking their own actions ahead of regulatory pressure.
And why would an exchange like EBS do that?
Well, because of its customers. It's historically an interbank market, and the bank customers were not at all happy with the presence of high-frequency type traders piling in there and put a lot of pressure on. And the exchange has come back and made quite substantial changes. Some last autumn, now some new ones are proposed in the sort of immediate future. And they claim that it has improved the quality of the market quite considerably.
So self-interested move, but many will be cheering it nevertheless. Thank you very much for that update.